Okay, hi, my name is Tanindra Sivaraja. So now I'll be talking about the basic accounting concepts. So for the introduction, we're going to say that the foundation of financial understanding to track, record, and make smarter decisions is the base of basic accounting concepts. So, and then as my part, now I'm going to talk about actuarial concept, which is allows a business to record revenue before receiving payment for goods sold, and record expenses as they are incurred. Expenses incurred but not yet paid must be accurate, and uncollected earned revenues must be accounted for. So in this concept, for an example situation I would give is the accrued revenue refers to the electricity consumption billed at the end of the period. So the utility is provided before payment. So the company incurs expenses throughout the month and receives revenue on monthly end. So for the second concept, so we're going to talk about the materiality concept. So in materiality concept, we're going to go about financial data that could affect the business choices out to be remembered for reports, taking into consideration effective spotlight on huge information. So little irrelevant causes can be discarded, while bigger effective exchanges should be uncovered to guarantee exact final financial evaluation. For an example, when a business chooses to expand small assets instead of capitalizing and depreciating them. So for the next one, I'll be talking about consistency concept. When a business adopt an accounting method, they need to follow the method consistently in the future according to periods. So the objective of this concept is ensure that the performance of the different years can be measured and judged on the same basis by year. So for an example, if we say business use the cash basis of accounting, they need to apply it to the cash flow statement, balance sheet, and income statement. That's all from me. Thank you.
Hi, my name is Subatira Devi and I'll be explaining about separate entity. So separate entity is like the business and the owner treated as two different people. So if an example, the owner uses like 500 of their own money to pay from their groceries, it's not recorded in the business account. So the next one is going concern. The business is expected to keep running in the future. So as an example, a company buys equipment to use for the next 5 years of for the company, assuming it won't shut down anytime soon. So the third one would be objective. The financial record must be based on real proof, not like guesswork. So example, sales are recorded only when there's an invoice and not just someone saying like, I think we sold 1,000. Not, it won't work like that. So the next one is prudent. So it is meaning that be careful, don't overstate profits or assets. So if a customer might not pay, we might record it is a possible loss even if they might still pay later. So that's all from me. Thank you.
Hi, my name is Nia Shasha. So I will explain my part, which is money measurement, which is means that only transaction that can be expressed in monetary terms are recorded in the finance statement. So it's qualitative aspects such as employee, moral, or customer satisfaction, which is cannot be easily quantified. Like for example, like a company might hire skilled workers, but the value of their expertise or moral isn't reflected in financial statement unless it translates into monetary terms. And then next is comparability, which is principle ensure that financial statement from different period of or different company can be compared easily. So this is achieved by applying consistent accounting principle and practice over time. So like for example, like if a company change its accounting method, it must restate prior period statement to make them comparable to the current one. And lastly is historical cost, which is company or business must account for a record or asset at the original cost or purchase price on their balance sheet, and no adjustment are made to reflect fluctuation in the market or change resulting for inflationary fluctuation. For example, like if a company buy a building for 100k, so the historic cost of that building 100k, so regardless of its current market value. And the lastly is conclusion. So the conclusion is basic accounting concepts are essential of maintaining clarity, consistency, and reliability in financial reporting. So they guide how transactions are recorded and interpreted, helping users make informed financial decision. And understanding this concept build a strong foundation for anyone studying or working in business. So that's all from me. Thank you.